Hello, everyone. I'm going to go ahead and get started. It's the top of the hour. I'm so excited to have you guys with us here today. We've got a very special event. We haven't done these in quite a while, but we're really glad to have you guys with us here today. You see a lot of familiar faces, a lot of new faces here on the session today. Just want to welcome you all. This is Richard Van Rich again here with Jeff Tompkins. Really excited to have you guys here with Altos Trading. Before I bring on Jeff, let me just read the disclaimer. Trading securities and options involves risk. Prior to buying and selling an option, investor must receive a copy of the characteristics and risks of standardized options. Investors need a broker to trade securities, and options must meet suitability requirements. Past results are not necessarily indicative of future performance, and performance figures are based on actual trades, including real money results. Due to time-critical nature of trading, broker fees, and the activity of other subscribers, there's no guarantee that subscribers will mirror our performance, and performance numbers shown are based on trades users could enter based on the trade signals. So you notice there's a Q&A box and chat box located at the bottom of your screen. You can pop questions there. We'll answer those towards the back end. We want to make sure we're respectful of everybody's time and get through the session today, but we will answer questions there. So you can pop those in. And with that being said, let me bring on Jeff. Jeff, you there?
I'm here. Greetings and salutations.
Greetings, greetings.
Greetings. Welcome, welcome. Great to have everybody here today.
Yeah,
All
a full
right.
house.
Yeah, full house. Got people still coming in the room, so we'll give people time to hop in the room here, but want to be respectful of everybody's time. So we have a lot to cover today, a lot of really great stuff. And as you probably guessed and saw, we're going to be discussing how to take some of the more popular and common option strategies out there and focus on what to do when things go wrong and how to make adjustments to these trades that aren't working out for us. Now, the good news is a lot of them do work out for us. The vast majority do, but uh, there are occasions when we encounter some challenges, and I'm going to show you how you can actually mitigate risk and in many cases even take a losing trade and transform it into a net profitable outcome. So again, lots to cover. Get your pen and paper handy. Uh, I don't know if Richard mentioned this is recorded. Try to stay with us live because we are going to do Q&A. And if any questions come up, we want to make sure to address those live. But we will be sending out a recording if for any reason you have to hop off early. Um, all right, so let's go ahead and dive in. And by the way, if anybody has any audio or visual troubles during the session, please put those in the chat or the Q&A box and let us know. But it looks like everybody can hear me okay now, so that's a good thing. So we're going to start out with a little exercise, a little quiz. And this might not seem trading related, but you'll see how we tie this in to the topic of our session today. So does anyone have any idea what these two products have in common? These are two common household products, WD-40 and the Nintendo gaming system. Anyone have any idea what WD-40 and the Nintendo gaming system have in common? I know it doesn't seem like this could be related to trading, but again, we'll tie this in, and it might not be what you guess. Alex had no idea. This is a hard one. It's very seldom somebody gets this. I'll give you a hint. It's not spraying the WD-40 into the Nintendo gaming system to get the game to go in. I think I actually tried that when I was a kid. Uh, Pivot Man says it'd be WD-40 and duct tape. Yeah, that would be. Well, I'll go ahead and give it to you. I don't see any correct answers. Again, I admit it's a tricky one. Robert said they don't have the letter Z in the product name. Joan said slippery slopes fast. Joan might be on the right track there. Okay, I'm gonna give it to you. Believe it or not, both of these products actually failed miserably early in their product life cycles, which you wouldn't guess because they're now wildly successful products and market leaders today. But Nintendo, which of course, again, we now know is the gaming company that launched this whole era of home gaming, didn't start out as a success, believe it or not. In fact, their first offering, the Famicom console, had to be recalled after only a few months. And then Atari came along in the mid 80s and kind of messed up the whole video game market. Nintendo addressed that by launching their NES, which barely sold in the mid 80s. So they were facing a lot of challenges until they made one little tweak to their business model, and they introduced those two little guys you see there, Mario and Luigi. And that turned everything around for them. They, again, became the market leader in the home video game space. And as we know it today, of course, a wildly successful company. Okay. So it was Mario and Luigi that really changed the history of American gaming forever. Now, kind of a similar story with WD-40. If you've ever wondered where WD-40 got its name, it actually comes from the fact that the formula represents the 40th attempt to create a degreaser and rust protection solvent. So they failed 39 times before WD-40 came to market, and they had a lot of challenges getting this lubricant into an aerosolized solution. It was originally used in the aerospace industry, but then the employees started using it, it became popular with them, and they were using it for home use, right? But imagine if they had given up after 39 tries, we might not have WD-40 as we know it today, right? And so the take home message here is that virtually every business faces failures, and it's no different with trading and investing. Okay, we all encounter failures. I'll give you a little background on myself. I know a lot of you know me, but if you don't, I'll kind of give you a brief background. But I've been trading for over a couple decades, and I've gone through everything that probably all of you have gone through. I've faced all the trials and tribulations, and I've blown up accounts. I've done it all, but I didn't give up. And ultimately, what changed it? I'm gonna fill you in on what changed it for me, okay? Because there's one really specific thing that turned everything around for me. But let's look at why very few traders make it, okay? And there can be a lot of causes of failure in trading and investing. Ultimately, it's the losing trades that wipe out profits from our winning trades that result in the low success rate for traders and investors. And so, I look at that as our overhead in the trading business. So I think if you don't already, you should look at trading as a business, right? It's really no different than any other business model, right? Where we have revenues and we have overhead, and our revenues are going to be our successful trades, right? And our overhead typically it's a low barrier to entry business, right? You need an internet connection, a computer, and a brokerage account with some risk capital, right? And you can typically start out with like $500 with most brokers. So it's a low overhead business in that sense. So really our biggest overhead is our losing trades, right? And so like any other business, we want to minimize our overhead as much as possible. Now, here's the good news. I found, and this is from my personal experience, up to 75% of the losses that traders experience can be fixed, and up to 75% can be completely avoided from the get-go. And I found this because before I was focusing on trade management and making adjustments to trades, I would just enter the trade and let it go and then exit, either with a win or a loss. And of course, there's going to be a kind of, if I'm adhering to my system, a fixed percentage of losses. And that was pretty, I would say pretty predictable, right? So I had a pretty good idea of what my win-loss percentage was. But then I started focusing more on trade management. And I realized that a lot of these trades I was losing, I could actually turn around. So yeah, some of the losses are simply a cost of doing business in the trading world. We can't avoid them all. But a lot of them can be avoided and even turn into profitable trades by making a few simple tweaks to the trade. So imagine if you could take, a popular option strategy like the iron condor, and let's say you had set up an iron condor on the S&P 500 index, the SPX, and things weren't going as planned. And say, you traded a 10 lot and you're down $3,900. So you have a choice to make. You could take that loss, or you could make a simple tweak to that trade and turn it into a $2,400 net profitable outcome. Or how about another popular option strategy, the credit spread? Let's say you've set up a credit spread on the Qs, things aren't going as planned. You hit a few roadblocks and the trade's down $580. So again, you could take that loss or make a simple tweak to the trade and turn it into a net profitable outcome of $620. Another popular option strategy, put selling. So this is a strategy we'll look at as well. Let's say you've written puts on Sienna, ticker CIEN. Once again, things aren't going as planned. Okay, the underlying moves against you. You're down $730. Okay, you can take the loss, or you can make a simple adjustment and turn it into a 540 net profitable outcome potential. Now, these are not hypothetical results or examples. Okay, these are actual scenarios that we encountered with our members at Altos, where we followed our plan. Okay, we adhered to the plan, but the market threw us a curveball, and that just is inevitable. Okay, and so we had that choice to make. Do we take the loss, or do we adjust the position? And in these cases, we made the decision to make an adjustment, and I'm going to walk you through exactly how we did this. And we turned these opportunities that would have otherwise been losses into net profitable outcomes. Okay. So we're going to walk through how we accomplish this, but these are real world examples. Now, I'm going to be covering some of my most effective adjustment techniques on the session today for, again, some of the more popular option strategies. Now, everything that I share, I back up with real world, real money proof. Okay. I think that's very important. It's very easy to throw out hypotheticals and say, hey, if I had just done this in hindsight, it would have been great. Okay. We're not going to do that. We're going to show real world examples. So I'm going to be showing screenshots right out of my personal brokerage account, for instance. So this is right out of my Thinkorswim account. All right. And if you look at the date down in the bottom right corner, this is back from August 24th, 2015. Does anybody know the significance of that date? You can throw it in the chat if you know. I know what is that, like over 10 years ago. I'll be actually surprised if anyone knows, although I guess you could Google it. But there's something interesting that happened on August 24th, 2015. And at this point in time, I had a portfolio of short put positions. I'll explain what that is. I don't see any correct answers yet, so I'll give this one to you as well. This was the day of the flash crash. So the Dow opened down like over 1,000 points. I think it was an unprecedented gap down in the markets at that point in time, and everybody was scrambling, right? People that had long positions on were trying to figure out what to do. People were taking heavy losses. Okay, and so I've got this portfolio of look roughly 10 or so positions, and they're all short puts. So I've sold put premium on these underlyings. Okay, there's a mixture of stocks, ETFs, and indexes. Okay, and if you're familiar with the strategy, and if you're not, that's okay. I'm going to walk through it. When you sell put premium, it's a kind of neutral to bullish strategy, right? So you want the underlying to either go up, stay flat, right? Stay relatively close to the share price when you enter the position, or it can move against you slightly. Okay. You don't want a major adverse move. You don't want a big sell off in the underlying stock. But that's exactly what happened on August 24th, 2015. So I'm sitting there like, okay, I've got this portfolio of short puts. And if you look at the percent change column, right, everything is down. Some double digits, 12, 10, 14%. Okay, I should have a very negative P&L on the day. But if you look at my P&L, okay, it's over $7,600. So how in the world do I have a portfolio of short put positions that should be experiencing heavy losses, but I'm showing a P&L of over $7,600? Well, I accomplished this with a very specific adjustment technique that I'm going to share with you on the session. So sit tight. We're going to get to that momentarily, and I'll show you exactly how I did this. All right, but I want you to know there's an adjustment to fix virtually every bad trade. Now, we can't fix all of them. In many cases, we can mitigate losses. And also in many cases, we can take what would be a losing trade and transform it into a net profitable outcome. So over the next hour, I'm going to reveal a few of my most effective adjustment techniques to fix losing options trades. Okay, so we're going to look at popular option strategies like the credit spread. Let's say you have a credit spread that is losing money, right? Well, you can execute what's called a delta neutral hedge and potentially transform it into a net profitable outcome. Or as we looked at, a short put, where you can execute a horizontal roll and take that losing put position and turn it into a potential net profitable outcome. You can do this with virtually any option strategy, even single leg long calls and long puts. Okay, for instance, you could take a losing long call and convert it into a vertical spread and turn it into a potential net winner. Now, it's very, very important. So listen closely that we walk through exactly how to do this, because you can't just simply transform these into a new position using these techniques without knowing all the details. And in some cases, it might require more than one adjustment. So I'm going to walk you through all of that, okay? But before I do, I'll just give you a quick, brief background on myself. If you're not familiar with me, I'm, again, Jeff Tompkins. Pleasure to have everybody here today. I have over 2 decades of experience trading the stock, options, and futures markets, and received my professional training as an intern at the trade desk at Morgan Stanley back in the early 2000s. And this is actually an exciting time of the year because we're coming up on our 10-year anniversary at Altos. So about 10 years ago, launched Altos Trading, where I'm the currently the chief investment strategist. We've rapidly grown to over 60,000 members in over 100 countries across the globe. I'm also a hedge fund manager, so I manage money for my clients at Altos Capital. So I launched my hedge fund back at the start of 2020, and obviously a difficult time to launch a fund, right? I was just a few months before the COVID crash, and certainly had some challenging market environments since the launch. Obviously, the bear market of 2022 traded through the recent tariff crash. We have never had a losing year in the hedge fund. So Altos Capital has had positive years every year since we've launched. And I really credit what I teach our members at Altos with that. So my goal is to teach you hedge fund level strategies. And a lot of that focuses on trade management. Not, it's all too common that we focus on trade entry, right? We get lured by some fancy indicator that's going to give us, the perfect entry price, and it's going to tell us exactly where to get out, and we're going to be fabulously wealthy, right? But then that just doesn't pan out. It just doesn't happen. Okay. And so really the important part of trading centers around the management of the trade. And that's what we're here today to do, is focus on that. Okay. And that's what I do in my hedge fund. Okay. And really what I credit the success to. Okay. I've developed indicators that are designed to be forward looking and not lagging. And I'm also the manager of some of the top performing stock and options alert services out there in the market today. And I'm going to be sharing the results of those going back an entire decade. Okay, so we have track records that go back 10 years, and I'm going to share with you the results. And I think you're going to be blown away because I haven't seen anything else out there in the market like that. Okay, that has achieved those results over such a long period of time. Most stuff, that's out there, it's fly by night, right? It works for maybe 3 months, 6 months, maybe a year if you're lucky, and then it starts to fail. Okay, but we're here to change that. So by the end of our session, you're going to discover how to fix losing options trades and even turn them into winning trades. So I'm going to reveal some of my top trade adjustment tricks to reduce risk and increase profit potential. So whether you're just starting out or you're a seasoned veteran, this is must-have information for today's markets. Now, let's start to dig into some strategy. Okay, probably one of the most common questions I get when new members come to us at Altos is, which is better, selling options or buying options? And we probably all encounter that question when we first get into the world of options trading. Well, I tend to tell people that one isn't better than the other. It really depends on which is appropriate for the right market environment. For instance, the right level of implied volatility. It's dependent on the underlying asset. There's a lot of variables. But if we look at it from more of a high level objective perspective, selling options typically has better statistical odds than buying options. And what really gets me excited is if you do it correctly, and I'm going to show you how to do it correctly on the session today, it has better statistical odds than a casino has over its gamblers. Now, why is that exciting? Because we all know that casinos have built-in edges. They have what we call a positive expectancy. And as long as they're executing, right, correctly, so as long as people are playing the game by the rules, they are guaranteed to make money over the long run. Now, they could have a bad day, and I think this is where it's a good analogy with traders, right? We can all have bad days. We can all have bad weeks. We could have a bad month, right? Casinos have that too, but they're still building billion-dollar hotels. Okay, so that tells you something. But how and why are they doing that? Because they have positive expectancy. They have a statistical edge. Okay, and we can do that with option selling. And what's exciting is I've run the math. Okay, the statistical edge, and again, you have to do it correctly because you can really screw it up and destroy that edge very easily, and to where the edge goes to the person on the other side of the trade. All right, but that edge can be greater than the edge in roulette, the edge in blackjack, craps, name any casino game. Okay. Now, when we look at option selling, you have three ways to win. Okay. If you're implementing a bullish option selling strategy. Okay. The underlying stock can go up, it could stay flat, or it can even move against you slightly. Now, this is great because it immediately gives you a built-in edge where you don't really have to do anything in terms of trade management. Now that differs widely from if you, for instance, just bought the underlying stock. Now, if you just buy the shares of the stock, you only have one way to win. That stock has to go up, right? If it stays flat, you make nothing. If it goes down, you lose money. So you have out of those three possible outcomes, you only have one way out of three to make money. That's different with option selling. Again, when done correctly, you have three potential ways to make money. Okay. Now, part of the reason for that is option selling allows time decay to work in your favor. Okay. And we're going to talk more about that. Now, what's also important is that when we sell premium in the way that we do it at Altos, there's more room for error and it's typically easier to adjust the trade versus an option buying strategy. Okay. Again, you can adjust any options trade, but there are various challenges around those dependent on the option strategy. So it typically is easier to adjust short premium, and I'll elaborate more on that too. Okay, so let's start to dive into strategy. We're gonna first talk about one of our core strategies at Altus, which is selling puts for income. All right, now I'll just walk you through this, give you a high level if you're not familiar. Probably a lot of you are, but a naked put or a short put is basically when you sell to open put options. So you're selling put premium to an option buyer, a put buyer. Okay, and so you collect that premium or a credit in your brokerage account for entering the trade. Now, when the underlying stock rises and the put options that you sold expire out of the money, you get to keep the entire premium you collected when you sold them. Okay, so we'll look at just a generic example. Okay, let's say that ABC stock's trading at $100 per share. You decide to sell to open 10 contracts at the 95 strike. Let's just say that you sell those for $250 a contract. Okay, now each contract controls 100 shares of stock. Okay, so you would collect a credit of $2,500 in your brokerage account. And let's say these expire in just a couple weeks. Typically, we do relatively short duration option selling strategies. So we're typically looking to turn these around in just 2 weeks or less. Okay. And then there's a reason for that. It's largely centered around time decay. But again, I'll elaborate more. Now, getting back to the example, okay, we collect $2,500 into our brokerage account. So as long as ABC stock closes above our strike price, the 95 strike, at expiration, we keep that entire $2,500 premium. Pretty cool, right? Sounds easy, right? Well, like anything else, things can go wrong. So I'm going to get to that in a second. But first, I want to dispel a couple of misconceptions about this strategy. Okay, there's a common misconception that selling naked puts is extremely risky. Okay, interestingly, if you overlay a short put risk graph on top of a covered call risk graph, they're going to look identical. So selling put premium, okay, has the same risk profile as a covered call. Now, if you go out and ask, a random retail trader which strategy is more risky or which is safer, they're probably going to say the covered call strategy is safer. Okay, they have the same risk profile. Now, even brokers treat short puts or naked puts as it typically requires a higher level of approval from your broker. Okay, why is that? Well, like anything else, there's the potential for the trader to mishandle it, mistreat it, over leverage. Okay, when you have a covered call, right, you already own the shares. Okay, but they actually have identical risk profiles. Okay, the difference is in you. You can screw things up. You can over leverage. Okay. So keep that in mind. Now, when done correctly, it can be an incredibly consistent method for collecting income from the options market. Okay, and I'm going to show you how to do that on the session today. Now, it's actually how Warren Buffett acquires stock for Berkshire Hathaway. Okay, he'll sell put premium to acquire shares at a lower cost basis. Now, that's not going to be our intention. Our intention is to sell the put premium and keep that. Okay, we don't have the intention of owning the shares of the underlying, but that is one kind of method for acquiring shares of stock as well. Okay. Now, the fact is, the single biggest difference between amateur traders and professional traders is the ability to adjust losing trades. It's really that simple. Okay, and I've actually done a little bit of my own study on this, where I just threw darts at a dartboard, not literally, but figuratively, and just entered some trades. I didn't use any indicators. I didn't use any technical analysis or fundamental analysis. I just put a trade on. And I was curious if I just put that on at the worst possible time, I was completely wrong on everything, could I adjust that trade into net profitability? Okay. And amazingly, I've been able to do that over and over again. okay, using the adjustments we're going to get to in just a second. Now, most traders enter a trade and cross their fingers, okay? They have one exit strategy. They either win or they take a loss. But the bottom line is when a trade doesn't work out as intended, it doesn't have to be an inevitable loss. Okay, a simple tweak can often save the trade and even result in greater profits. Now, let's talk about what happens when things go wrong. Okay, so we always have two exit strategies with everything we do at Altos. Okay, so we have our primary exit strategy. Now, in the case of selling put premium, that's where the put expires out of the money and we keep 100% of that premium that we collected. Now, this occurs about 80, in fact, it's higher than this. I tell people expect about 85% of the time. Okay, you don't have to even touch the trade. Okay, it's gonna expire in your favor. You don't even have to close it out. Your broker closes it out for you. You retain that entire credit. Realistically, in actual real world historical data, we're above 90%. We're probably around 90, 92% of the time. We don't even have to touch the trade. But that still means that about, 8 to 10% of the time, we have to manage that position. This is where our secondary exit strategy comes in and where we need to make an adjustment to the trade. Now, one of our favorite adjustment strategies often results in even greater profits. Now, this sounds counterintuitive. I'm going to walk you through a real world example. What do I mean? So, when something goes wrong in life, okay, generally our best, expectation is that we can mitigate the damage to some degree, right? But we don't generally expect that we're going to come out better off when something goes bad. But I'm going to actually show you where we've encountered difficult situations. A trade has moved against us. We made some tweaks to that trade, very simple, and we came out better off than had nothing gone wrong to begin with. So it's almost like, I mean, it's our, inherent desire to not have things go wrong, right? We want everything to work out for us. But it's almost like it's better if something doesn't work out because we have the potential to actually come out better off. Now, again, this is counterintuitive, but I'll walk you through a real world example. So how do we adjust the losing short put? Now, there are again a whole host of ways to adjust any option strategy. I'm going to give you my top two adjustment techniques for adjusting a short put that's not working out. Okay. So first we're going to look at rolling. Now rolling involves closing out our initial trade, so our initial short puts, and then opening a new trade at a further out expiration. We typically do this at the same strike and the same number of contracts. So we're not increasing our position exposure. We're not scaling, up in contracts. Okay. We're not typically changing the strike price. Occasionally we'll do a vertical roll. I'll explain that too. But all we're generally doing is just extending our time horizon. But there's something very powerful in that I'm going to get to that you need to understand. Because we want to do this for an equal or greater credit. Okay, so we call this staying net cash positive. Okay, so I'm going to get to that. Now, this one adjustment technique alone, in one of our top option selling strategies that we issue to our members at Altos, has resulted out of 415 trade recommendations over the past decade. 416 closed as winners in net profitable outcomes. We currently have two open positions that are in adjustment. So we're currently adjusting two open positions. We have, I think, 3 or 4 other open positions that were just recently opened and are set to close out profitably without any adjustments required. Okay, so that'll probably jump up to about 420 here by next week. Okay, but the point is, look at the consistency. Now, again, most of these trades we didn't have to even touch, but the ones that we did, we came out better off had nothing gone wrong to begin with. And I'm going to walk you through some examples in just a second. Now, the other adjustment technique we'll occasionally use is delta neutral hedging. Okay, so a delta neutral hedge is a little more complex. And again, I'll walk you through it. I'm going to give you the formula. But in order to transform a naked put right into a delta neutral position, we just have to buy or buy to open enough at the money or near the money put options to offset, or we don't always get perfectly delta neutral, but we want to get close. And again, I'll explain this, don't worry, as possible, okay, to offset the positive delta of the existing short puts, okay? And when we do this, okay, if we continue to get an adverse move, this can actually offset the losses in the original short put and produce a net profitable outcome, okay? Let's look at a real world example. Okay, this is one we did with our members on Micron in a prior year. Okay, so July 12th of a prior year, we alerted our members to sell puts on Micron, ticker MU, with an August week 4 expiration at the 44.50 strike. And at the time, that could be done for $55 a contract. Okay, so in all of our examples, we're going to use a 10 lot, 10 contracts. Okay, so if you sold 10 contracts, okay, you're collecting $550 in your brokerage account right when you put the trade on, less any brokerage commissions and fees. Okay, now in this case, we got an adverse move fairly early on in the trade. Micron started to rotate lower. Okay, now remember, with when we're selling put premium, that's what we don't want to have happen, right? We want the stock to either stay flat, go up, or it can move against us a little bit. In this case, we had a pretty significant adverse move in Micron. So how do we address this? Well, on September 27th, okay, we rolled these, and I think, sorry, that's a typo. That should be 912, not 712. We rolled these contracts out, okay? We were debited $1.19 on the original position. Okay, remember we were credited 55, then debited $1.19. We just rolled out a couple weeks to October week 2. Same strike price. We didn't adjust the strike. We didn't increase the number of contracts, but we rolled out for a $2.16 credit. So that's $216 per contract. All right. So notice what happened there. We stayed net cash positive by rolling out for a lower debit and collecting a larger credit. This is critical. Okay, you don't want to roll for a debit. Okay, then you're just digging yourself into a deeper hole. Now, what happened here? Well, as we're coming up to expiration, okay, so just less than 2 weeks later, okay, we were able to close this trade out at a 52-cent debit. Okay, now what's interesting in this example is that at that point in time, Micron was trading at 43.59. Now remember, our strike's at 44.50. So we're trading almost a dollar below the strike price when the position was closed. Okay. So we didn't even recover back above the strike. Yet, because we rolled and stayed net cash positive, so we rolled for a net credit, this resulted in a profit potential of $820 for every 10 contracts traded. Now I'm going to point something out here. And again, sorry for the typo, back on September 12th, when the trade was entered, okay, what was our maximum profit potential? It was $55 a contract or $550 on a 10 lot. We couldn't make any more than that. That's our max profit potential when you sell put premium. It's the credit that you receive when you put the trade on. Okay. In this case, we had an adverse move in the underlying stock. We made a simple adjustment. The stock didn't even recover back above the strike price, and we closed the position out better off than had nothing gone wrong to begin with. So again, it's counterintuitive, but had everything just gone as planned, we would have had a $550 profit on a 10 lot. Instead, we had an $820 profit potential with one adjustment. And part of the reason for this is that our changes in implied volatility. So even though the stock didn't recover back above the short strike, the implied volatility decreased. And that's part of what we're waiting for, because that is directly correlated to the option premium pricing, right? So there's a direct correlation. When implied volatility decreases, so does the premium. Okay, so rolling works when you do it correctly because it allows you to stay net cash positive while taking advantages of decreases in implied volatility and increases in the underlying share price. And the silver lining is you don't necessarily have to recover past your short strike in order to be profitable. Since we're staying net cash positive with the rolling adjustments, the net credits over time can offset the debits. Okay, like in this example with Micron. Now, I told you we'd come back to this this point in time about 10 years ago, August 24th, 2015, and the screenshot from my Thinkorswim account, where I had this portfolio of short put positions in the midst of a flash crash. Dow's down over 1,000 points. I should have a major negative P&L on the day, but my P&L is over $7,600. How did I do this? So I accomplished this with the other adjustment strategy that I just mentioned, delta neutral hedging. So I went to work and I executed what's called a delta neutral hedge on all of my short put positions. Okay, and I'm going to give you the formula for this. Okay, most of this you won't have to calculate. Your broker will calculate it for you. I'll point out the one little simple piece of math you have to do. Okay, but first we need to get our position delta. Okay, so we just take the number of contracts in our position, multiply it by the delta times 100. That's going to give us our position delta. Okay, again, your broker platform will give that to you. We're then going to divide the at the money option delta by the position delta to get the number of contracts to buy. Now I'm going to give you an example so this all is very clear. I know when you learn something new, it's kind of like, don't worry, it's actually pretty easy. So that's the only little piece of math you do. You just divide the at the money strike delta into your position delta. And the result is a delta neutral hedge that can profit on a decline in the underlying security. So it's very important that you use the right adjustment strategy for the right market environment. So this is more of an aggressive adjustment strategy and one that I'll use like in the midst of something like a flash crash. So here's an example of what it looks like. Okay, let's just say we sold put premium on this, it doesn't matter, ABC stock at the 58 strike. Okay, well, you can see here that that strike is now in the money. In other words, the underlying stock has sold off and is trading below the strike. That's what we don't want to have happen when we sell put premium. Okay, so how do we delta neutral hedge this position? Well, if we look at the delta column, and you could ignore the negative. Okay, puts have a negative delta, calls have a positive delta. We ignore that negative. It's 0.59 is our delta. Okay, now again, we'll use a 10 lot as our example. So our position delta, if we plug it into the formula, and again, your broker platform will give this to you, is going to be 590. Okay, so we have a 590 delta that we need to hedge. So we're going to take the at the money strike delta. That's just the strike price that's closest to the current underlying share price. In this case, that's the 57 strike. We're going to take that delta, which is 48, and divide it into our position delta. And that's going to spit out a number. Okay, this is our delta neutral hedge number. It spits out 12.29. Now, of course, we can't buy 12.29 option contracts. So we'll just round up or down to the nearest whole number. So we round down to 12. So this tells us that we need to buy 12 57 strike contracts to neutralize the delta in our short put position. So we're not even going to touch the 58 strike short puts. We just leave them alone and we go in and buy 12 57 strike contracts. We've now transformed this position into a vertical spread with a skewed contract size and a delta neutral position status. And if that underlying stock continues to sell off, that new leg that we've added to convert it to a vertical spread can outpace the profit in that can outpace the loss in the original short put position if the underlying stock continues to sell off. And this is exactly what I did on August 24th, 2015, the day of the flash crash, to produce a P&L on a portfolio of short put positions of over $7,600. Okay, there it is. All right, now let's get into the next strategy. Okay, we're going to look at credit spreads and iron condors. Now, credit spreads are a popular option strategy. They're created by buying cheaper option contracts, simultaneously writing an equal number of more expensive option contracts. It's probably, most people, their journey starts with just buying a single leg call or put. This is typically the next strategy people go to. It was for me, at least. I started out just buying calls and puts, realized how difficult that was to make money over the long run. Then I thought, well, maybe I need to go to vertical spreads. I went to credit spreads. Okay. So you like the short put strategy, right? You receive a credit or cash into your brokerage account for executing the trade. Now that credit is your max profit potential. Okay. And it's why they're called credit spreads. Now an iron condor is simply the combination of two credit spreads. So it's a bull put spread, a bear call spread, same underlying stock, same underlying or expiration. Okay. Now, why do I like iron condors and credit spreads? I'm going to tell you, I used to hate iron condors and credit spreads. I started out liking them. Okay. And that is because when I first started trading them, I had, I think, like 10 or 12 consecutive winners. And I thought, wow, this is so easy. I'm going to quit my day job and do this full time, and I'll be, a multimillionaire probably by the end of the year. Well, the good news is I didn't quit my job, thankfully, because I think on the 13th trade, I wiped out all of those winners. Okay. This is common. This happens to all of us. And so I thought, well, man, when I was just buying a call or a put, I really had to hit a bullseye, right? I had to throw the dart right in the center of the board, be right on my delta, gamma, theta, vega, my timing. I had to get everything right. Okay. With credit spreads and iron condors, you don't necessarily have to do that. You can really throw darts all over the dartboard and still potentially make money. But we have that issue to face. There's the negative risk reward skew, right? Where you can have a series of successful trades that is wiped out by one bad trade. Okay. And so this is why I then quickly grew to dislike credit spreads and iron condors until I discovered how to effectively adjust these and manage them. So how do we do that? Okay. Now, you can also delta neutral hedge spreads. So for it's just the process is a little different. And there's different ways to do it. And I'll give you a couple examples. So in order to transform a credit spread or iron condor into a delta neutral position, if either the short put or short call strike is breached, we this is kind of a quick and dirty way to do it. We can just close half of the contracts at the breach strike. And that's going to help offset losses and even produce a profit if the underlying continues to move past the spread. Now, you don't want to just do this blindly. You got to be very careful, okay, because it can work against you as well. Okay, but delta neutral hedging can produce winning trades with a profit greater than the initial credit. So again, kind of like that example we looked at, it's counter with put selling. It's counterintuitive, right? When we looked at the Micron example, if something goes wrong, we expect that maybe we can make it a little less bad, right? But we don't think that we're going to actually come out better off than had nothing gone wrong to begin with. But let's look at an example of where it actually did. So this is from a prior year on June 15th. We set up an iron condor on the S&P 500 index, the SPX. This is one we did with our members at Altos. Okay, we alerted them to set up the iron condor with a June week 5 expiration. Okay, so we're just going a couple weeks out, which is what we'll typically do, as I mentioned, with our premium selling strategies. We're looking to turn these around in a relatively short period of time. But in that short period of time, things can go wrong. Okay, so this one could be put on for 110 a contract. Okay, so we'll use the 10 lot again. That's $1,100 of credit deposited right in your brokerage account right when you put the trade on, plus any brokerage commissions and fees. Now, in this case, we had an adverse move. The whole market environment changed. The market structure shifted. Okay, it was out of our control. We didn't do anything wrong. We followed the plan. We did everything as we normally do, but we can't control what the market does. What we can control is how we adapt to it. So that's what we did. We adapted by delta neutral hedging this position. So we had a breach of our 27.25 strike puts. Okay, so in other words, the SPX sold off. Okay, our call spread was perfectly fine, leaving the position with a potential $3,900 loss on 10 contracts. Okay, so if you're only doing one contract, you're looking at a drawdown of 390 bucks. All right, so we could have just accepted that and said, hey, market threw us a curveball. Let's take the loss and move on to the next trade, or do what we did. We alerted our members to adjust this using a delta neutral hedge. So we alerted them to close half the 27.25 strike puts. Now the SPX, as we expected, continued to sell off. And the very next day, June 27th, this position could be closed for a $240 per contract profit, turning that $3,900 loss into a potential profit of $2,400 per 10 contracts. Now, once again, I'm going to point out, if we go back to June 15th when this trade was put on, let's say everything went as planned, nothing went wrong. Our max profit potential is 110 a contract, so $1,100 on a 10 lot. We encountered a little bit of a difficulty during the trade cycle. We made a very simple adjustment and we walked away with a better outcome. In fact, more than double, right? If we double that 1,100, we get 2,200. We'd more than doubled our profit potential by making an adjustment when something went wrong. So delta neutral hedging can work magic when the underlying continues to move in the direction of your breach vertical credit spread. Okay, but again, you need to make sure you use it in the right, conditions, the right market environment. Now, this is the only hypothetical example I have in the whole session. So this is, and I share it because it was a trade we were looking at putting on Apple with our Altos members. Okay, we didn't end up putting it on, but anytime I do all the research on a trade, and even if I don't enter it, I still use it as a learning lesson. So had I entered this, what would have happened and how would have I addressed it if I needed to, right? Manage that. Well, this is a great example. So we were looking at doing a bear call credit spread on Apple. Reason being, and this is from way back in like 2020, I think. Yeah, 2020. Okay. Reason being, Apple had a very well-defined layer of overhead resistance back in early December of that year. You can see it right there on the chart, right around the 125.50 level. Okay, we have kind of a double top formation. So on December 9th, we get a test of that level and then a sell-off that day, get a rotation lower in Apple. It looked like that resistance was going to hold, so we were going to set up a bear call credit spread right around that level. Well, again, for whatever reason, I don't remember why, we didn't end up issuing the alert. We found something maybe better. But had we, look what would have happened, right? We just in the next week, we blew through that level. Okay. So had we put on a bear call credit spread, we would have easily breached that in a very short period of time. Okay. We just blew right through that resistance level. All right. So how could we have managed this? Well, if we had put on a call credit spread right around that resistance level, and that's, by the way, one of the techniques I use when we sell premium is to base it on a critical level of support or resistance. Okay, so if we're doing a bear strategy, we're looking for layers of resistance. Okay, we'd identified one. So if we built a spread around that layer of resistance, we could sell the 125 strike calls and then buy the 127s for a 2-point wide spread. Okay, and at that point in time, this trade could be put on for a $59 credit. Okay, so on a 10 lot, again, that's $590. Now we saw what happened there on the chart. Okay, Apple blew through the resistance layer. And as you can see, our open P&L, we would have been down $560 on a 10 lot. Okay, again, we could have just taken that loss and moved on. Here's another way to delta neutral hedge. Okay, rather than closing a portion of your short strikes, of the breach strikes, we can plug in a long call right in between our spread. Okay, and so we'll stick with the same expiration cycle, this December 31st, and we're just going to go in and buy right the 126 strike calls, right, just right in between our 125 127 spread. Now a little kind of tip here: you can run the delta neutral hedge calculation if you want to try to really perfectly delta neutral hedge this. If you kind of just want to do a quick and dirty method, my minimum contract size is half the contracts in the spread. So that'll be kind of a less aggressive adjustment. So when we're doing a 10 lot spread, we could buy 5 126 strike calls. The maximum I'll do is the number of contracts in the spread. So in this case, 10, and that's going to be more aggressive. So if we really, and that's why I selected this adjustment for this example, because as you can see, we blew through that resistance level on strong volume with a close near the daily high range. It was a very aggressive resistance breakout. Okay, so we want to match our adjustment, and I'm going to give you some tips here in just a minute on matching adjustments to market conditions. We want to match that to the behavior of the underlying price action. Okay, so if we go aggressive, we buy 10 126 strike calls. Okay, same expiration December 31st. What happens? Well, if we fast forward to expiration day on December 31st, if we just held our original 125 127 call credit spread, we would have had about a max loss on that. Okay, about $1,400. Look what happens to the long 126 strike calls that we plugged in right in between our spread. They pick up a P&L of $6,300. So that's a net gain, including the losing trade that we're not even touching, of almost $5,000 on a 10 lot. Okay, just using one simple adjustment. So guys, as I've mentioned, there's many adjustment techniques for virtually every option strategy out there. I want to give you some crucial tips. Okay, trade adjustments can be both defensive and offensive. So as I just mentioned, your trade adjustment must match the strength of the move in the underlying security. So if the market's in a sharp decline, like back on August 24, 2015, in that example I showed you of the flash crash, okay, a delta neutral hedge might be the appropriate adjustment technique, and it can turn losing trades into big winners. If the underlying slightly breaches our spread, maybe we're in a low vol environment, okay, but volatility is starting to maybe increase. Maybe rolling makes more sense. It can help us ride out the trend until it reverses, or until we take advantage of that spike in vol and then the vol crush that inevitably follows it. But the trick is with adjustments is not just knowing how to execute them, as I'm showing you on the session today, but when and what to adjust. Okay. Sometimes it just doesn't make sense to make an adjustment. Sometimes we just need to accept a loss. But now you know that up to 75% of losing trades can be avoidable. And there's an adjustment to fix virtually every bad trade out there. I've revealed a few of my most effective adjustment techniques to fix losing options trades. And guys, time is not money. It's really the most valuable resource on the planet, right? We can't earn or create more time. We can't get it back. Okay. Money, on the other hand, replenishes. So the trick is that we just need to stay in the game to replenish the money. Okay. I used to trade my time for money. I now trade so that I can have time to do things. Okay. I got into trading probably like most of us. I had dollar signs in my eyes. I realized it pretty early on, it wasn't as easy as I thought or hoped it would be. And I had faced a lot of failures, like all of us do. And it was really the management part of the trade, the adjustments that turned everything around with me, for me. Now I don't care about the money. It sounds crazy. Like I don't care. I don't care about any individual trade. I don't care if I have a bad trade. I have those too. I'm just like you guys. I have bad trades. Okay. I have trades that wipe out a series of winners. Okay. It happens to all of us. But I don't care because I have the confidence now to, and I know that I have a positive expectancy, and I have the proof. Okay, we've done this with our members for 10 years at Altos. Okay, that I will come out ahead in the long run. Okay, and so now I don't trade necessarily for the money specifically. Obviously, that's why I do it, but I really do it so that I can have more time to do the things that I love. So for those of you who don't know me well, I'm an avid fly fisherman. This is me behind my house in Idaho, fly fishing the river. I live right on the river in Boise. I love backcountry skiing. I love taking international trips. This is one of my trips to Venice. Love going on sailboat cruises. This is me on the sailboat in my old stomping grounds back in the San Francisco Bay, which is where I grew up. But this is really why I enjoy doing this. You see all the crazy stuff out there in social media, people, bragging about their rented Lamborghinis and all that crazy stuff. It's all BS. Okay, most of it's not real. There aren't many people out there that can really back up what they preach. Okay, we're gonna do that today. Okay, and I'm gonna show you again a decade's worth of proof. Okay, so we have a very special package today. It's our Altos Triple Play package, which includes our very best option selling strategies and our buy zone equity and ETF alert service. So it includes 12 to 15 real-time trade alerts per month. Okay, so you get an average of one trade alert per strategy per week. And our typical holding period is it's short duration. So most of these we hold for 14 days or less. Exceptions might be if we do have to make an adjustment that might extend beyond that. We have a target average win rate of 85% for these services. As I mentioned, we far exceeded that. And again, I'm going to show you our track record from this year even. I missed an update there. That's now like 400 and what was it? 418, I think, net winners, and just our put selling service. Here's the results going back. So we launched this in 2015. Our first, right at the end of the year. So our first expirations came around right at the start of 2016. Okay, this is just the put selling strategy. Okay, going back to when we launched. Okay, we have some open positions this year, and of course we still have about a month and a half left in the year, even in bear markets. So you would think like this strategy must not do very well in a bear market. Well, look at 2022. That was a full-on bear market. Okay, and we still came out with a profit. Okay, I really credit the trade management part of this. Amazingly, we didn't still have to really adjust many more trades that year, but nevertheless, right, even in a bear market, we can take what's normally what's considered a bullish strategy and make money with it. So guys, I mean, the profit potential here is through the roof. This is just one strategy. And again, we've been doing this with our members for a decade now. But this is really all set up to help you earn while you learn. Okay. I love that Tony Robbins quote. If you want to be successful at something, find someone who's achieved the results you want and copy what they do. All right. So I'm going to ask you to let me guide you with live trade examples. Okay. These are going to help reinforce what I've taught you so far in today's session, and learn how to adjust losing trades in real time with live examples. Here's a bonus tip. You're going to use the trade alerts as reinforcement to test your proficiency and raise your confidence. So you really have to do this in real time with somebody who knows how to do it. Okay, that's important. So we send these out, and I'm going to let you know how you can get these right to your own inbox in just a second to our members every week. This is what the alerts look like. Okay, so this is one we previously issued on the TLT. It was an Iron Condor. On the TLT, we sent this out to our members, and it includes an annotated chart, all the exact instructions. You can literally just copy and paste these into your broker platform. This one was done for a 40% credit, so $480 in credit or deposited into the account for putting the trade on a 10 lot. Okay, this had an absolute, excuse me, return of over 19% in only 14 days. So that annualizes out to over 495%. You also get our buy zone alerts. So we issue alerts on stocks and ETFs as well. If you maybe don't trade options or you trade both options and equities and ETFs, okay, you have that ability with our triple play package. This is what our stock alert looks like. Again, you get the annotated chart with all the key levels, all the rationale for the trade, the exact entry and exit prices. You're never left guessing where to get in and where to get out. This one on Morgan Stanley, we alerted our members to buy in at 52 a share or 52.06. Close this one out just a short time later, 13 days later at 56.05. That's an annualized return of 266%. Here's what one of our credit spread alerts looks like. This one we did on the triple leverage Qs. Again, give you the exact strikes, the expirations, and even a screenshot of the order dialog box and the annotated charts. This one was done for a $540 deposit into the brokerage account on a 10 lot, over a 21% absolute return in the trade for only 13 days, annualized out to over 616%. All right, so as a new member to our triple play service, okay, you're going to get access to our best trades in real time. You don't need to sit and watch your computer all day. We actually send all new alerts out after market hours. So if you have a day job, or maybe you're retired and you're out on the golf course or doing something else you love to do, okay, you don't need to be stuck or glued to your computer during market hours because we issue the new alerts after the market closes for the next day. So you have all that afternoon, evening, and the next morning before the opening bell to get your order in with your broker. Okay. Very, very simple, easy to read instructions. You get the annotated charts, the order entry screenshots, and trade adjustments are included. So if for any reason we need to make an adjustment to that position, you're going to be alerted with the exact instructions to do it. Here's real world, real money, guys. This is our put writer service from this year. Okay. Again, we have open positions currently. I think we have 4 open positions right now. But these are consecutive. These are all closed. They're consecutive. Our open ones are, our newly open ones were open after October 10th. Those are all set to expire in our favor. These are all consecutive winners. Okay. We've only had to adjust, I think, 3 of these. Okay. We have not had a net loss this year. This is our credit spread and Iron Condor service for 2025. Check it out. This is every trade we did with our members in this service. Okay, we've had 3 negative trades out of all of these recommendations that we issued. Okay, this is the success behind what we do. And as you follow along, and again, I'm going to let you know how you can get these for yourself in just a second, but as you're following along with these, okay, you're going to learn how to do this. My goal is for you to be able to do this for yourself, but it takes time, right? You need to kind of get with the flow, figure out why I'm doing what I'm doing, when I'm doing it, and if we do encounter a challenge, how I'm addressing it. Okay. Now there's even more. So I'm going to walk you through everything we built into the Altos Triple Play package, and then I'm going to let you know how you can get this for yourself. So you're going to get an entire year of our top 3 options in equity and ETF alert services. Okay. These normally retail by themselves for $1,499. You're going to get trade adjustments as well. That's included in your alert package. You're also going to get additional online training. So you're going to get access to our professional trading series online course that normally retails for $997. Okay, you're getting access to that. So imagine what we did today. You know, we have about an hour or so together today. Okay, multiply that by like 10. Okay, you're going to get a whole lot more education. You're also going to get access to our private invitation-only Facebook group of about 900 members. You're going to get our additional training on trade adjustments. So again, we have limited time together today. Um, there's a whole lot more as it goes as it relates to trade adjustments. Okay, that's all going to be built into the online curriculum that I'm going to give you access to. We normally retail that for $900, but ultimately learn to trade whatever asset class you're interested in: equities, ETFs, futures, forex, options. We do it all. Okay, and we have these really incredible bonuses. Again, you get the professional trading series course, and you get my latest guide, how to create risk-free trades. The first alerts go out tomorrow, guys. So I'm going to let you know how you can get the very first alerts, which are going out tomorrow evening after the closing bell. Okay, they usually go out late afternoon, early evening. The total retail value in the package is over $4,500. Okay, we are knocking 78% off today. You can literally get this entire package for just a few, what breaks down to a few bucks a day. Okay, $9.97. We limit this because it is a huge discount. Okay, and we put a lot of time, effort, and work into this. All right. And so we technically lose money on this over the long run. And so we limit it for that reason. It's not a marketing ploy. It's not to, for any other reason other than we want to get you on board, get you successful, get you proficient, get you confident. Okay. And we are looking for very serious people that are ready to do that at that 78% discount. So the link to claim this is altostrading.com/bundle. You can hop right over there. Richard will get that right in the chat for you. If you can just click right out of the chat to claim that 78% discount and get this Altos Triple Play package. Now, I'm going to open it up to questions in just a second. You might be wondering, well, who's this for? So we've designed the Triple Play package to be ideal for anyone who's maybe just starting out, all the way up to seasoned traders. We have people that are brand new, and we have professional institutional traders on board with us at Altos. I'm one of them, right? And you get all the instructions. So if you're just starting out, right, you can literally read the instructions to your broker. You can copy and paste it in your platform. You can, but my goal here is to teach you, right? So I'm gonna also be explaining why I'm doing what I'm doing. Okay, so that's okay if you're just starting out. If you're already successful or already a veteran trader and you just want more opportunity, or maybe you want to cut down on your research time, right? I'm here to help you do that. So it's for people who work full-time jobs that are part-time, retired. We have members all over the world. In fact, we have members in over 100 countries across the globe. Your account size is irrelevant. Okay, you're going to decide your position sizing, how many contracts you want to trade, what your risk tolerance is. That's all up to you. You maintain full control over all those decisions. Okay, you maintain control over your account. You might not be able to take every trade, and you don't need to. Don't feel pressured, right? Maybe some of our members that are in our triple play bundle package gravitate to one strategy. They really like, for instance, credit spreads. And maybe they're not interested in some put premium. That's okay. That's why we built this package, is so that you have the flexibility to choose the strategies that you like. And some of our members trade all of them because they love the amazing results that we've achieved over the past decade. But this works for traders who want to learn how to trade on their own. Okay. Again, we're here to help you do that. If you want to, go off and do this on your own, we're here to support that. But if you also just want to be spoon-fed, that's perfectly fine too. Okay. We'll keep sending you the alerts as long as you want to receive them. Okay. We get thousands and thousands of testimonials from our members on a daily basis. Okay. Damien wrote into me and said, short, concise, straight to the point, no fluff, no bluff, real stuff. Apparently Damien's a poet. I really like this one. That's why I included it. That makes money. Okay. D-Lim wrote in and said, Jet does a great job with option strategies, great for beginners and intermediate traders. Chris said, first of all, I want to thank you for providing such a first-class alert service. It's really the only one that delivers on promise, and I've tried a few. After having demo traded for nearly 2 months, I'm now happy to go live. And by the way, guys, I do encourage you to demo trade always. Always paper trade. Get comfortable before you risk your hard-earned money. Okay, so I won't go through more, but we get a whole lot of these, okay? Now, I have a guarantee. If you aren't profitable trading the alerts in the first 90 days, and that could mean that you don't even trade it. I realize life gets busy. Maybe things get in the way and you haven't had a chance yet. Or maybe you're paper trading, which again, I encourage you to do. It doesn't matter what the reason is. We're going to give you $1,000 to spend on any of our other highly acclaimed online trading courses, coaching services, trade indicators. You get to pick. We're going to give you $1,000 store credit. Okay. in addition to another year of trade alerts on us. Okay. That's our guarantee. Okay. Because we believe in everything we do. Okay. Very strongly. But we also want to back you up. We want to make sure that you're comfortable and ready to roll. All right, so what's going to happen next? You're automatically going to be added to our members list for trade alerts and directed to the trade alert membership registration page. Then once you register, you're going to receive a confirmation email in just a few hours confirming your access. You're going to get access to the members portal. That's where you're going to find your professional trading series online course. You'll find past alerts. You're going to find everything in that members portal. Okay. And then you're also going to find your special bonuses in there as well. Again, you're going to get the Professional Trading Series online course, which is over 9.5 hours of on demand training in 9 modules. It includes our best options, stock, and Forex strategies. You can watch it anytime at your leisure. It doesn't expire and includes all updates, all future updates and additions we make to the course in the curriculum. It also comes with our coaching trade tracker spreadsheet that will help you keep track of all your trades. It's a really powerful spreadsheet. I use it for myself. I even use it to keep track of my hedge fund trades. Okay. It includes a whole lot more. Okay. We cover trade management, trade adjustments, chart reading, technical analysis, the whole gamut. Okay. And then you're going to get my latest ebook guide, How to Create Risk-Free Trades. This is a money management ebook that covers different money management tactics to mitigate risk and in some cases eliminate it from your positions. All right. Now I'm going to go ahead and open it up to questions. So I also want to, most of you probably have our contact information, but if you don't, want to make sure that you do. Our email is support@altostrading.com and our toll-free number is 800-895-9348. Once again, that link is altostrading.com/bundle to take advantage of that 78% discount today only for being here on the webinar. So this is a webinar only discount. Okay. We don't offer this on our website or anywhere else for the triple play package. All right. Richard, if you're still there, just out of the corner of my eye, I see that questions have been coming in, but I haven't been monitoring. So maybe if you want to relay any questions that have come through, and I'd be happy to address those.
Absolutely. Yeah, we got a handful of questions here. Some around how many trades per month do they typically get?
Great question. So you should expect on it. So number one, we never force a trade. Okay. Just for the sake of sending an alert out. Okay. We're sending you the best of the best. We want all of these obviously to have the maximum potential for profit. So we don't force trades. With that said, you should expect about one alert per week per strategy. So that's going to break down to, I would say on average, about 3 to 4 new trade opportunities per week. Okay, so probably about 15 to 20 trade opportunities per month
Okay,
across the
perfect.
entire triple play package.
And are they obligated to take all those trades or?
Great. Yeah, another good question. Yeah, please do not feel obligated to take them all. It's a lot of trades. Okay, that's going to be entirely dependent on your, your personal circumstances, your account size, your preference for strategy. Okay, we've designed this robust triple play package to cater to different styles of trading, different preferences for strategy. Okay, maybe as I mentioned, we have members who just like the equity and ETF alerts. They don't trade options. That's fine. They just like to get the research on the options play, and they'll use that to then trade the underlying stock or ETF. Okay, there's a lot of ways you can use this, obviously, but yeah, you decide how many trades you want to place, and don't feel pressured like you have to take all of them because it's a lot.
Okay, perfect. I just want to tell Sebastian, Ryan, and Linda that yes, we did see that all three of you guys are in. The seats are filling up. Let's see here.
Welcome, guys. Great to have you on board.
Yeah, Dirk wants to know how are the trade alerts different from, are these the same ones that you get in the live trade room or are these different altogether?
Another great question. Yeah, so these are different. On rare occasions, there might be a little bit of overlap, but these are going to be different alerts than you would get in the live trade room.
So
Sometimes we just find something that's so great that we'll send it out to everyone in our services, but it's a very small percentage.
a lot of people came in late. Just want to let everybody know that there is a replay um that's going to go out to you guys. So be on the lookout for that.
Yeah, if you hopped on late, if you missed anything, please do go back and review the replay. I covered a ton of really valuable tips, tricks, methodologies for managing and adjusting some of the more popular option strategies, what to do when things go wrong, and walk through specific examples of how to make these very specific but rather simple adjustments that can actually take a losing trade and transform it into a net profitable outcome. So if you missed any of that, please do go back and review it, and that recording will be available to you.
Joan asked, she kind of missed some of the uh, meat in the middle. Are put writing trades the buying of puts, or what's put writing?
Okay, good question. Yeah, so again, if you missed that part, I do walk through the strategy and how to do it, but it's actually selling put premium. So it involves selling to open puts. So we're selling puts to put buyers. And so yeah, I did walk through all that. Please review the recording if you missed it. Um, but again, with the alerts, okay, you get all the instructions on that. So it will give you the order types, the exact instructions, sell to open, X strike at X expiration on X underlying security.
John B asked, is the 997 a annual or a lifetime price?
Another great question. Yeah, so this is you get an entire year of all four strategies. So it's for the year, which again we normally retail these individually for 14.99. So it's for the full year. Um, and then at that point, it's up to you if you want to renew. Many of our members have been with us for many, many years. We have members that have been with us since the very beginning, a decade ago, incredibly. But that's up to you. We don't lock you into any contracts, or anything like that. So at the end of the year, you can make the decision, hey, I've learned everything that I think I need to learn to go off and do this on my own. If that's the case, great. Then we encourage that. But maybe you don't want to spend all the time and legwork doing all the research and figuring this out, and you want to stick on. You're welcome to do that too, and you're locked in and grandfathered at that 78% discount. We never raise the price on you, and we don't lock you into contracts.
Awesome. I got a strategy question that asked a little
Oh,
bit
actually,
earlier.
sorry, before you get to the strategy
Yeah.
question, I do want to mention one other thing. We do have an option if you don't want to have the annual subscription. We have the option to get all of this for life. So once you go to altostrading.com/bundle, okay, you're gonna enroll, you're gonna have an option to upgrade to a lifetime package, so you get the alerts for life there. So yeah, you will have that option. I forgot to mention that.
Yeah, it's important. He can say goodbye to subscription fees forever with this.
Yeah, yeah.
I mean, 10 years, that's crazy.
Yeah, yeah, yeah. We have a lot of lifetime members that have been getting this for many, many years, and they're just killing it, and they don't have the subscription, so they're loving it, loving life.
That's awesome. John asked a little bit earlier, how much time do you want when you're doing like your delta neutral position? Are you trying to hold that for weeks or
Another great question, and this is the importance of getting involved with the triple play package, watching how this plays out in real time, because the challenge is there's not a one size fits all answer to that question. Okay. There isn't a universal amount. It's highly dependent on current market conditions, the market environment, uh, things like implied volatility, price action of the underlying. There's a number of variables that will differ per position, right? So unfortunately, there's not a universal answer to that. And that's why it's so important that you get involved and watch how, because really the way to learn this is to watch how this plays out in actual market conditions. And so it's just like really anything else you learn, right? You can learn it on paper, okay? And you know the facts maybe, but you don't necessarily know how to execute. Okay. Many of you may not know that I'm a private pilot, so I'm getting my pilot's license, and I learned there's a lot of like book study around that, and I learn a lot, but then it's nothing like going up, getting in the cockpit of the plane, and flying. Right? They're two completely different things, because the weather on any given day is never the same. right? The barometric pressure, all of the things that I need to know when I go up in the air change every single day. And so I can read something in the book, but then I need to know actually how to apply that when conditions change. And that's really, I think, analogous to trade adjustments and the triple play package, and why we designed this is so you can kind of watch that play out. But typically, just so I don't want to leave you completely hanging on that question, you know, when I do make adjustments, it's going to be largely dependent on again, key levels, so supply and demand levels, support and resistance, whether those are breached, whether that breach is a false breach and we reverse back. It's going to be based on the magnitude of the breach around that strike. It's going to be based on levels of implied volatility. It's going to be based on on duration, how much time is left to expiration. So again, there's a lot of variables, but those are some of the things that are going to come into play. And typically when we make a delta neutral hedge adjustment, it's going to be at the same expiration cycle. But occasionally, if we're getting close to expiration, we may need to execute what I call a combo adjustment. So we might need to roll and delta neutral hedge uh, essentially simultaneously. Okay, so again, those are just some complexities that are going to be variables depending on conditions. But also keep in mind with delta neutral hedging, that adjustment's reversible. So if we looked at that example on Apple, for instance, right? If we put that adjustment on and then the market conditions change again, so we're kind of getting whipsawed, right? We can take the adjustment off and then we can, if needed, pivot to a different adjustment. So again, there's some complexities there, but hopefully that kind of helps clarify a little bit.
Yeah, that's super helpful. Um, let's see. Terry's asking, 'cause this is kind of a double question. Are you selling naked puts or put spreads?
Good question. So in our put writer strategy, we sell naked puts. And again, if you missed that part of the session, I walk through all of that. I also dispel the common misconception that naked puts are extremely risky. I talked about how if you overlay a short put risk graph onto a covered call risk graph, they're identical. Most people don't know that. And most people won't tell you that a covered call strategy is risky. Where does the risk come in? It comes in through you. Do you mistreat the strategy? Do you over leverage? Okay. If you treat it correctly, right? You don't over leverage, for instance. The risk is not any more than writing covered calls. Now, with that said, some people may not have the level of options approval with their broker. Typically, you just need do one of two things. You just contact your broker, tell them that you want to increase your level of options trading approval. Okay. And they'll typically look at your, account history. Uh, and if that doesn't, pan out, let them know that you're receiving trade recommendations from a hedge fund manager, and that you're just simply executing the recommendations, and they'll almost always grant that. But if you prefer not to do single leg puts, you can also trade these as vertical spreads. Okay, and that's why we include all this education in the triple play package. Okay, so if you're not familiar with a vertical spread, right, you can sell or short a strike and then simultaneously buy a lower strike put, okay, to create a vertical spread, and that's a defined risk strategy. And we have members who do that. That they'll take the short put position, and they, for various reasons, prefer not to trade a short put, and they'll just trade it as a vertical spread. So you have the flexibility to do that. But we issue the alert as a single leg short put.
Perfect. Do these services integrate with WisePub? Mark is asking.
Um, I'm not quite sure what you mean by integrate, but WisePub is our live trade room portal. Um, and that might be kind of in line with one of the previous questions we got. Like, are these recommendations we're doing in the live trade room, and they are separate. Again, there might be just a tiny bit of overlap if we find like a real hot opportunity. Sometimes we'll blast those out to all of our members and all of our services. Um, but otherwise they're different. So yeah, this won't be this will be separate from the trade room from WisePub.
And can some of the members trade these positions in their retirement accounts or
Great question. Yeah, so all of these strategies can be traded in IRAs, in retirement accounts. They are retirement account friendly. And we have a lot of members who trade these in their retirement accounts.
gotcha. Let's see here. Yeah, seats are filling up pretty quick. Let's see here. Some people are asking some questions like, what would happen if, let's say, someone got assigned 3 days before expiration? Is there a typical way that they usually handle that? Or,
Yeah, so I'm assuming that's referring to the short put
yeah,
strategy. Yeah, assignment, is not an issue with vertical spreads. You're always defined risk and hedge with the long strike, which you have the right but not obligation to exercise if you prefer to. Um, with the short puts, if assignment occurs, what we do and what I do personally, if I ever get assigned on a short put, and my intention is not to own shares of the underlying, I do what's called unassigning myself. So what I do is I simply sell those shares back to my broker and re-enter the original position that I was in. And that's essentially a wash because because if you're assigned, right, there's that intrinsic value in the option that makes up that difference. So you sell the shares back, you re-enter the original position, and you're basically back to square one where you were before you got assigned. Only difference being most brokers do charge a nominal assignment fee. Like I think at least before Schwab acquired TD Ameritrade, I think TD Ameritrade charged like $20 or something. But that would be really the only difference. So yeah, that's the strategy I use if I don't want to own shares of the underlying, which I typically don't when I'm writing put premium. So yeah, that's how I address that.
perfect. Julie asked this question a couple times. When you showed the SPX example, you mentioned the short 27-25 put, but I wondered if you could show some of those other strikes in that example in the teaching.
Oh, yeah. If you could write here, let me throw our contact information up. If you could write into us, I can give you um, the full Iron Condor spread that we did.
Perfect.
Yeah, shoot us an email and we'll send that over to you. I don't have it in the slide deck because I just wanted to focus on the breach of that short strike. But yeah, we can send that to you.
Perfect. Perfect. Simon asked, is the training portion of this package lifetime access? Like the
Oh yeah, yeah. So you'll have access to everything as long as your membership is active. So if after the first year uh, don't want to continue, then you won't have access to the members portal at that point. But as I mentioned, once you go to altostrading.com/bundle and you enroll at the 78% discount, you're going to be offered an even bigger discount and you can get everything for life. And that's how you would get lifetime access to all the training and everything you see here. But as long as you're a member, you have full access. So and again, nothing expires. You can watch it at your leisure. Um, and you have all the time in the world to do that. So yeah.
Yeah, I just really want to piggyback on that. Like the trading component of this package is really truly like I think the most value. I mean, the trade alerts are awesome. Again, like you're seeing these wonderful results over the past decade. But again, like Jeff said, he started this service to essentially teach people how to catch their own fish while also giving them fish, on a weekly basis. And I think there's no better way to learn than learning a strategy and then seeing live examples of really an expert. Again, as Jeff said, is like with Tony Robbins, like if you want to be great at something, find an expert and do what they do. You'll be able to do what he does and learn what he's doing and why he's doing it over the course of your membership. And honestly, like that's the one thing that took me from being a very below average trader to being able to do all the things that I can do today, trading professionally because of what I learned from Jeff in those early years. So I think there's really no better way to learn. The educational value is crucial to it. And again, like it allows you to earn while you learn.
Yeah, a lot of people out there probably don't know. Richard was one of my early students. when I started out teaching these strategies on a site called udemy.com. And I became one of the top instructors on Udemy, and I think I have around 30,000 students on Udemy. And Richard was one of my students, and so that's how Richard and I met. A lot of people don't know that, but yeah, yeah, it's
Yes.
been cool to see Richard, transition and grow and become successful. But that's obviously what we're striving to do with all of you guys, right? And so yeah, I want to welcome all of our. The seats are almost taken, so there you have just a little bit of opportunity left to scoop up one of those last remaining seats at that discount. And then remember, guys, you get your first alerts tomorrow evening. There, you might even get one tonight. Again, I've got some research to do today. There's potential you can get one tonight, but at the very latest, your first alerts are going to hit your inbox tomorrow evening. So yeah, we have some really, I've already got some really great stuff on the radar this week. So you're going to have some really cool opportunities this week. Just wanted to let everybody know who's joined so far to keep an eye out for those.
Yeah, and also, just so you guys know, you don't have to day trade with this strategy. A couple of questions come in to like, do PDT rules apply and all that kind of stuff. Jeff sends these out after the market's closed, so you have all night to put these trades in before the market opens. So you're not having to sit in front of your computer
Yeah.
to
And in
make money.
fact, the PDT, the pattern day trading rules are changing and going, a lot of it's going away anyway. But yeah, no, no day trading required. And yeah, as Richard mentioned, all the new alerts go out after market hours. So you have ample time, that afternoon, evening, next morning, pre opening bell to get these orders in with your broker. I mean, it literally takes you a minute or less to copy and paste that order. But yeah, you have plenty of time. The only exception would be if we make an adjustment to a position. So those will be the only ones that could potentially go out during market hours. They may still, even adjustments may go out after market hours, but there are positions that we adjust on expiration day during market hours. So that would be the only exception. But all the new alerts go out in the evenings after market hours.
Perfect. That's all I got.
All right. Well, once again, want to welcome all of our new members into the Triple Play package. Great to have you guys on board. Looking forward to getting your success stories. Want to thank all of you for being here today. I hope you learned a lot as it relates to trade management, trade adjustments, and what to do when things go wrong with some of the more popular option strategies out there. I hope it's transformative. I hope it makes a huge difference in your bottom line and your trading. And as always, if you have questions, please do not hesitate to reach out to us. We have a great customer support team. There, once again, is our contact info. And by the way, if you prefer to place your order over the phone, you're welcome to. There's our toll-free number. Uh, It's kind of funny. I don't think toll-free exists anymore. It's like everything's toll-free anyway. But I'm just, from back in my childhood days, used to saying toll-free. But anyway, there's our 800 number. And there's again the link, altostrading.com/bundle. Looking forward to working with all of you. Welcome aboard. And looking forward to seeing you in the next session. With that, take care. Wish you a great rest of the day. As always, trade safe. We'll see you soon.